Can the Reliance Nippon Life Increasing Income Insurance Plan guarantee income growth for financial stability in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a non-linked, non-participating individual savings life insurance plan. And some of the key features of this policy are you can enjoy life insurance coverage for the entire policy term, and you can choose from policy term of 12, 16, 20 or even 24 years with premium payment required for only half of the selected term, and you can opt for one of the two income options, which is the income with maturity benefit option or income only benefit option. And you can also receive a guaranteed monthly income starting at the end of the premium payment period, which is continuing until your maturity period. The guaranteed monthly income begins at 1% of the base sum assured and increases by 0.25% each policy year. And under the income with maturity benefit option, you will receive twice your base sum assured upon survival at maturity. You can also enjoy tax benefits on both premiums paid and benefits received under applicable income tax laws. Now let us take a look at the key benefits available under this plan. So first is the death benefit. So unfortunately, if the policyholder passes away during the policy term, then the nominee or the legal heir will get the death benefit. So this death benefit differs based on the death benefit option you have chosen at inception of the policy, which could be death benefit option 11x or death benefit option 7x. Next is the maturity benefit, which as a policyholder, if you survive till the end of the policy term, then once the policy matures, you will get the guaranteed sum assured. So a guaranteed sum assured on maturity is defined as twice the base sum assured. Another additional benefit this policy has is the guaranteed monthly income benefit. So basically, you will receive your guaranteed monthly income in arrears after the end of your premium payment term on survival of your the policyholder at the end of every month till the end of the policy term. So income with maturity benefit option is basically your guaranteed monthly income will be 1% of your base sum assured for the first year and then will increase by 0.25% in subsequent policy years at a simple rate. Only income option is something where your guaranteed monthly income is 2% of your base sum assured for the first year and will increase by 0.50% in the subsequent policy years at a simple rate. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are you can avail a loan of up to 80% of your policy surrender value. You can also enhance your policy coverage with additional rider options, and you can choose from flexible premium payment options including annual, semi-annual, quarterly or monthly payments, and each year your income will increase. So these are the advantages. The disadvantages are the life cover provided in this policy is insufficient, and receiving income benefits annually could lead to unplanned spending. The overall returns provided in this policy are comparatively low to other options in the market, and also the income benefit cannot be deferred, which may not align with your financial needs. And the annual withdrawals every year happening can interrupt the compounding growth of your investment. So these are all some of the drawbacks that you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let us now assess the potential returns of this policy to determine the internal rate of return (IRR) of this policy to get a better idea of whether investing in it for the long term is sustainable or not. So just for calculation purpose, let us assume that a 30-year-old male selects this policy with a base sum assured of 10 lakhs. So your death benefit will be 23.21 lakhs based on the plan option they have chosen. So the policy term is 20 years, the premium payment term is 10 years, which requires an annual premium of 2 lakhs 11,064 rupees. So after the premium payment term, he starts receiving income benefit with the first payout being 96,000, which increases annually. Additionally, a maturity benefit of 16 lakhs, which is twice the base sum assured, is paid at the end of the policy term. So the IRR for this cash flow, if you calculate it according to the policy's maturity calculator, comes around 4.11%. So basically, while this plan does offer guaranteed regular payout, the returns are lower than the inflation rate. Moreover, the annual payout may not be sufficient enough to cover your significant expenses, and since deferral is not an apt option, it could lead to unnecessary spending. So, the life cover also falls short of addressing the family's long term financial needs. So, this plan does not seem to give us a better return, like because it's giving us low returns and inadequate life coverage, which makes it unsuitable investment for achieving our long term financial goals. So, as this policy is not giving us the desirable outcome despite having some key benefits such as increasing income after the premium paying term and also the life coverage overall policy term, it's not giving us the desirable outcome we need. That's why we are going to or explore alternative investment through an alternative investment approach, where we are going to see whether the alternative investment can provide us similar benefits with the potential for higher returns. But the catch here is we are not going to invest in some insurance come investment policy. We are going to separate insurance and invest in it separately. So, using the same parameters as in the previous example, let us consider, just for an example scenario, that we opt for pure term life insurance policy for life cover with a sum assured of 25 lakhs, requiring an annual premium of 15,400 rupees over a 10-year premium payment term and a policy term of 20 years. Compared to the 2 lakh budget we had for the Reliance policy, here we are only going to pay 15,400 rupees. So this leaves us with 1,95,664 rupees annually available for investment, which can be allocated based on our risk profile. So if you are a low risk investor, you can opt for options like the Public Provident Fund PPF, which can be considered, while if you're a higher risk investor, you might want to explore equity based options such as the Equity Linked Savings Scheme ELSS. In this case, we assume the funds are going to be invested in an ELSS fund, which is also a tax saving fund. So now you can say that to generate regular cash withdrawal, what we are going to do is, in this strategy, the accumulated ELSS funds can be transferred to an instrument yielding 7% per annum after the premium payment term ends for the life insurance policy, like the pure term life insurance policy. So the final investment value is withdrawn to match the maturity benefit of the Reliance Nippon Life increasing income insurance plan. So the ELSS fund final pre-tax value stands at 43.07 lakhs and the post-tax value is 40.28 lakhs. This amount is then invested in a 7% per return instrument. So following a withdrawal pattern similar to the Reliance policy, the final value of the investment reaches 50.84 lakhs. This combined ERR with the combination of pure term insurance policy for the strategy involving pure term and ELSS investment comes to 8.38% post tax. So this return outpaces inflation, and if you avoid a periodic withdrawal, it could also result in greater returns. So when planning for life goals, we can see that separating insurance from investment generally leads to better financial outcome compared to relying on traditional life insurance policy. Now, what is the final verdict on our analysis on the Reliance Nippon Life increasing income insurance plan? Is it worth investing in the long term or not? This plan does provide guaranteed rising income and family protection. So while the guaranteed income feature may seem attractive for those seeking a regular income stream, its returns fall short of even basic debt instrument. So the increasing income benefits are unlikely to cover significant expenses and may lead to unnecessary spending, and it also has a high agent commission. Additionally, the sum assured is insufficient to meet your future financial needs. By combining insurance and investment, the Reliance Nippon Life increasing income insurance plan fails to deliver on both front. So as a long term investment, the plan does not meet the expectation of most investors. So for those seeking regular income, it's wiser to invest separately rather than rely on cash payout from life insurance. So at the same time, protecting your family against unforeseen risk is essential. That's why opting for a pure term life insurance policy which offers the best solution for life coverage is optimal.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.